presenter Stephen is currently on holiday, so my name's Andrew Whiteley. I'm the Senior Accounts Manager here at Harts, who will be introducing Chris Bentley, who will be talking you through the spring budget update of 2024. We've seen all the media information. You might have done a bit of research yourself, and now Chris will talk you through as much fine detail as possible. As ever, there'll be some questions and answers at the end. And obviously, if you think of anything after this meeting, please do get in contact and the team will be able to help you. Just a couple of forthcoming events. Next week, we see our quarterly business club meeting at Hollin Hall. If you're able to join us, that's fantastic. If you're not getting information about our events, please do contact the office. We can get you on a mailing list, and obviously you can then get all the information sent to you about forthcoming events. And there'll be information about our next webinar that's on the 18th of April. So without further ado, I shall pass you over to Chris Bentley, who will now talk you through the budget of 2024. Over to you, Chris.
Thank you very much, Andy. Yes, so this morning's webinar is on last week's budget. You've probably already seen a bit in the news. We're not trying to go over and be first to market. It's a bit more thinking through what it might actually mean for business owners and for our clients generally, and a few of the key themes that are coming out of it in terms of how tax might be structured slightly differently going forward for your business interests. So before going into the detail, let me please put up the disclaimer first, the standard disclaimer. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. So the formality's over. Key themes coming out of last week's budget. I think the first one is the ongoing freeze of income tax allowances. More and more are paying tax, more and more are paying higher rate tax, more and more are being caught by the 100 grand withdrawal of personal allowance, loss of childcare subsidies. More and more are now in the top rate of tax at 45%. If you think back, those 100 grand and 150 grand originally limits were set about 15 years ago now, and they haven't moved since. So far more people are being caught by those very high levels of tax. Similarly, the 50,000 higher rate threshold and the 12,500 personal allowance have both been set since 2021, and they've moved very little the year before that. And they're going to stay the same, we're told, until 2028. So over time, with the high inflation, everyone is paying more income tax, which then puts your thought of, are we properly structured? Are things set up as they should be from a tax planning perspective? Next major theme of the budget was there's a national insurance cut for the employed and the self-employed. That's the basic rate of national insurance, 12% recently reduced to 10% for employees, now going to 8%. For the self-employed, it's going from 9 to 6. A big drop. Those who are above the higher rate threshold, so that's the 50,270 again, they will continue to pay at 2%, no change to that. And there's also no change to the employer NIC rate, that remains at 13.8%. So it's very much a change in the focus of the tax system, that one. The government's also restoring child benefit to many middle earners. We'll come on to that in a bit more detail in due course. The furnished holiday lets regime, which a number of our clients have used and continue to use, that's being abolished. Furnished holiday lets will be treated going forward as if they were any other type of residential property for tax purposes. VAT will continue to be different. Again, we'll come on to that in due course. There was also a reduction in the capital gains tax rate on residential property disposals. Don't know if that was to go alongside the abolition of furnished holiday lets, encourage landlords to sell, or whether it was just an acceptance that there is more and more inflation going into the capital gains calculation. Don't know. And then finally, the other key theme for the budget was the replacement of the non-dom regime with a short-term temporary residence tax regime. I don't intend to go into that one in any detail. It's a specialist niche area of interest to a relatively small number of individuals and a relatively large number of politicians. So moving on to the detail of today's webinar on the budget. So we'll start with personal tax and a recap of the main headline rates and allowances. So the personal allowance is frozen at £12,570. The high rate threshold remains at £50,270. And the top rate threshold remains at £125,140, with a tapering of personal allowances once income exceeds £100,000. These allowances remain frozen until at least 2028, we're told. And as I've mentioned previously, more and more are being pulled into each of those rates. There are no changes to the headline rates of income tax, including for dividends. But what that means, as I reiterate again, high inflation and the length of freezes means this is an increase, a very large increase in the amount of tax that people are paying. On the other side, I think there's been an acceptance on the part of the government that the child benefit rules are causing problems and increasingly causing problems. The threshold when child benefit started to be withdrawn was set in, I think, 2013 at £50,000, and it had remained at that stage for 11 years, right the way through till 2024. Now, most people have had several inflationary pay rises during that period. In other words, the 50,000 threshold was cutting in at a far lower level of income than it had done previously. On top of that, there's a recognised unfairness in the system that the benefit is withdrawn once currently one half of the couple earns more than 50,000 and is fully withdrawn if one half of the couple earns more than 60,000 a year. However, so what that means is you can have a couple where one earns 60,000 and one is a stay-at-home parent, no child benefit. In the next house, you can have a couple both earning 50,000, so household income 100,000, and yet they receive full child benefit. It's also caused a lot of problems due to the way in which it's assessed on one partner, the higher earner, who might not be the one who receives the benefit. So I think recognising some of the problems in the system, the government has said that the threshold where the benefit starts to be withdrawn is being increased to 60,000 from the 6th of April, so in about 4 weeks' time. And the top threshold, after which it's fully withdrawn, is going to be increased to 80,000. So the rate of withdrawal is cut by half. And what that will do is it will mean that the effective tax rate for those who are subject to the tapered withdrawal is reduced. At the moment, if you've got 3 children and you're earning somewhere between 50 and 60,000, your effective tax rate is somewhere around 70%. If you've still got a student loan as well, that's closer to 80%. They've recognised it's a disincentive to work. So the planning point on that one is for many people who might have said at the moment that there's no point receiving child benefit, the higher earner is 60,000, 70,000, maybe even 80,000. Those couples need to get back in touch with the government and restart payments of child benefit from the 6th of April this year, because those couples will be able to receive some. And the worst that happens, if your income is over 80,000, it has to get paid back through the child benefit, high income child benefit charge. It's a pain, but if you don't claim it, you won't get to keep any of it. So though middle earners who are currently not receiving child benefit for their children do look at that again. The government also said that it intends to move eligibility for child benefit to being based on household income by April 2026, with a consultation due in due course. I think don't hold your breath on that one. The way the tax system works and the way the child benefit system works, it's going to be very, very difficult, which is why they're thinking about it for 2 years' time. The fundamental problem with it is that income tax is based wholly on the taxation of individuals, whereas they're trying to withdraw benefits based on household income, and the two don't mix particularly easily. So moving on from child benefit to national insurance, another big change in this last week's budget was a further 2% in reduction in employee national insurance contributions from 10% to 8% from the 6th of April. And that's on the band of earnings between 12,500 roughly and 50,000. The self-employed didn't see the cut in January, so their drop is actually from 9 to 6% from April. They're getting both cuts at once in April. Employees, of course, went from 12 to 10% in January. So that, coupled with the abolition of the Class 2 payment from April 2024, is a very significant tax cut for those on earned income. For someone who is at the top end of that income range, or indeed above, will be receiving about £1,500 a year tax cut, 4% on 37,000. I think the government's definitely put things out that they want to reduce national insurance and continue to reduce national insurance in that band. And there seems to be some kind of agenda around trying to make work pay. So that's why they're reducing national insurance rather than income tax. I suspect there could be something around cost in there as well. But you do find that people who are working see some very high tax rates, and that's perhaps what the government's trying to unravel somehow. And that might well be the reason why there's no change to employee NICs either. So those on the business owner side, there's not really any relief there. There's nothing been done to dividends, but there is for the staff. And as I'll come on to later, that tilts the balance further as to whether business owners might want to consider taking their drawings pay as you earn rather than as dividends in the future. We'll come on to look at some slides on that shortly. Furnished holiday lets is another change. This one it was rumoured a few days beforehand, but was quite a surprise in many ways. It wasn't something that everyone expected to go in the near future. But yes, the government has abolished or will be abolishing the separate regime for furnished holiday lets with effect from April of next year. We don't yet have all the transitional rules, but the expectation is that furnished holiday lets will be treated in exactly the same way as other residential lettings. In other words, the beneficial regime that they currently have will disappear. There are currently a number of beneficial tax treatments for the owners of furnished holiday lets, provided that the criteria are met around letting and things like that. The first one is that furnished holiday lets currently qualify for full mortgage interest deductions. Going forward, that's going to be restricted in the same way that it is for ordinary holiday lets. Currently, a business owner, someone who owns furnished holiday lets, is able to make pension contributions from the income on those properties. We expect that to disappear from April next year. So if you are using furnished holiday lets income to fill your pension, you want to be looking at doing that in the remainder of the current tax year to April 24, and then in the next tax year while you still can. If you decide to sell the property, currently it qualifies for business asset disposal relief in many cases. In the future, we expect that to be gone, and you'll be paying at 18 or 24% going forward rather than at 10%. There are also some changes to the rules on claiming tax relief on expenditure on fixtures and furnishings, etc. Generally, the regime will be slightly less generous going forward. So moving on from that to capital gains tax and inheritance tax. The annual exemption for capital gains tax is reducing from £6,000 to £3,000 in April 2024. This is actually the second stage of a reduction which was announced last year. Worth just mentioning for those who are looking to sell things in the near future, there is a benefit to getting it through before the 5th of April in many cases. However, before anyone rushes into doing something, it's also worth bearing in mind that the capital gains tax rate for property disposals, which previously would have been at 28%, is reducing to 24% from April. Maybe it's to encourage people to sell residential properties, I don't know. The capital gains tax on share disposals is 20% anyway. Inheritance tax, the rumour mill was definitely busy in the run-up to the budget, but there hasn't been any changes to rates or allowances. So the inheritance tax nil rate band of 325,000 and the main residence nil rate band of 175,000 remain frozen, and we expect that's published to be the case until 2028 as well. So moving on to the business side of things rather than the individual side of things. Not much change on this side at all in the budget. Corporation tax rates remain unchanged. The headline rate is 25%, with the small companies rate at 19% where profits are under 50,000, and then a tapered rate between those two limits. I will mention again that those limits of 50,000 and 250,000 are reduced, divided by the number of associated companies. So if you have two companies, they're 25,000 and 125,000, and so on. The associated companies rules are complicated and can catch things that you might not expect it to catch. Broadly, it's a case of if you don't need extra companies, you probably don't want them, because they may well lead to you paying more tax on those companies' profits where you do need that company. The other big change that is going on in the corporation tax world is full expensing. So being able to deduct the cost of plant and machinery, and that includes vans that you buy for use in the business. It keeps coming up in the press because for big business, it's recently been made permanent. However, the annual investment allowance, which has been around for a number of years, has effectively given this to most SMEs already. So, yeah, it is there. Do go on from a planning perspective, buy the computer equipment, buy the vehicles, buy the plant and machinery. But the current tax treatment remains in place. You continue to get full relief for that. So VAT, there was a change here, and for the first time in many years, the compulsory VAT registration threshold is being increased from 85,000 to 90,000, and the deregistration threshold is also going up to 88,000 from April. It's a small step. There are a lot of businesses that are a little below the VAT registration threshold, and I think it just enables them to grow slightly without being pulled into all of the compliance that being registered on VAT takes. and particular for consumer-facing businesses, there's a cost that comes to becoming VAT registered and having to charge VAT. On the business rates side, there's currently a 75% discount on business rates for those in the smaller businesses in the hospitality, leisure and retail sectors, and that's being extended for another 12 months to April 25. That last one isn't a new announcement, but I think it's worth putting in there for completeness. Similarly, the minimum wage increase isn't anything new. It was announced back in November, but due to the size of the increase, which is coming in on the 1st of April, I think it's worth reiterating it, because getting the minimum wage wrong is definitely something you don't want to do. The penalties for getting it wrong inadvertently or by a trivial amount are very large. So definitely pay attention to those wage rates. If you've got people who are currently at or around, or even for younger people within about 15 to 20% of the current minimum wage rates, you need to bear that in mind, as those people will be due a pay rise from the 1st of April. So having run through sort of some of the headlines in the budget, we'll now look at profit extraction and how the changes to national insurance contributions might change how we look at structuring businesses going forward. So I pulled up what looks like quite a complicated slide here to show the effective tax rates on taking money out of a business in various different ways. That's on the right-hand side. And the tables on the right-hand side, the top half shows the effective tax rates as they were in December 2023. So before the government started cutting the rate of national insurance. And in the lower half of the table, we've got the rates as they will be from next month, with both tax cuts for employees and the single larger tax cut for the self-employed having come through. Now, if we look in the basic rate column, what we see is the rate of tax for profits taxed on a sole trader or a partner in a partnership or an LLP is dropping from 29 to 26%. If you're a business owner and you take your money out by way of pay as you earn as a basic rate taxpayer, the effective tax rate drops from 40.25% to about 36.75%. If you're potentially wondering why those numbers look a bit odd or a bit strange and rounded, it's because we have to take into account the employer's national insurance, which you'll pay. So though these numbers are calculated, if you've got £100 of profit and you're a member of a partnership or an LLP or a sole trader, you would have paid 29% tax previously, going down to 26%. If you're a limited company and you took it out pay as you earn, well, the employer's national insurance is 13.8%. Of what you've got left of your £100 after paying that, as an individual, you will then pay income tax at 20%, and going forward, national insurance at 8%, so 28% of what's left. If we take all of those taxes together, we end up with an effective tax rate of 36.73% going forward. And if you look at dividends underneath the pay as you earn line, between the December 23 line and the April 24 line, there's no change. Dividends still remain at 31.5% roughly at basic rate. And then moving across to the right, there are no changes in tax rates for higher rate taxpayers or top rate taxpayers. Now, what springs out to me from those tables is that in an ideal world, you'd be able to take money out of your limited company by way of rent or interest. But actually, most people don't have a property that their limited company uses, which they can charge rent on, and they haven't had to lend enormous amounts to their limited company. So rent or interest isn't normally available. When it is, definitely worth using it as a means of tax efficient profit extraction. So that then comes down to the choice of whether a business is structured as a partnership or sole trade or as a limited company. And for years, we've all defaulted to the limited company. It's got to be more tax efficient. But with the drops in recent years in national insurance and the increases in corporation tax rates, these figures have been based on a corporation tax rate of 25%. With the increases in dividend tax, it's actually significantly cheaper at all levels to operate through a partnership or an LLP if you need the limited liability, or as a sole trader, and pay income tax on the profits rather than a mixture of corporation tax and income tax on your dividends or taking money out as pay as you earn. The one big downside though of operating as a sole trader or partner or LLP is that all of your profits are subject to tax as they arise. That's the same for corporation tax, but then you have control over when you take profits out and you pay the income tax on that. So you get a lot more control over what profits are subject to tax, and that can be used as a way to smooth out the good years and the bad years and avoid going over 100,000 in 1 year, for example. So it's not always the case that we would be advising people that, look, a partnership or LLP is cheaper than a limited company, but it definitely is something that's worth looking at going forward. Similarly, with the reduction in employee national insurance contributions, the effective tax rate on pay-as-you-earn drawings has reduced significantly. It is still more expensive to take money at pay-as-you-earn at basic rate, but at higher rates and at top rate, it's actually reversed. You're better taking your money out of the company pay-as-you-earn rather than as dividends. However, again, things are more nuanced than that. The dividends make it far easier to divert income to a lower earning spouse, significant other. They can be a shareholder in the company, not really need to do very much in the company, but they can receive a dividend in the same way that you could invest in a company on the stock market. You don't have to be involved in a company to receive dividends. However, to take a salary, then really you need to be doing something for the company. So operating as a limited company and paying through dividends does give you far more opportunity to get closer to taxation as a couple rather than as individuals. And if that means using both parties' basic rate bands and personal allowances, that's always very helpful for keeping the overall tax bill down. There's also a benefit for operating through a limited company in that it effectively extends the basic and higher rate bands. Quite complicated to explain how that works, but it's another reason why we might not automatically put people across to pay as you earn rather than dividends, or putting them automatically into an LLP. It's just something that if a new business is being set up, we would want to think through in a bit more detail than we might have done historically. And equally, if we were reviewing how a business owner took their drawings, we would be looking far more at whether we should take some money should be taken out pay as you earn as opposed to through dividends. Go back 5 to 10 years, an overdrawn loan account and no ability to take dividends was a disaster, huge tax bills coming out. That's not necessarily the case going forward. So position is far more complicated. Advantages do remain of operating through a limited company for income splitting and cash retention in a company. So, and then a few other tax changes just to mention at the end, perhaps to be aware of, things on the horizon, but not perhaps things that are going to change things immediately. The first one is that if you are a sole trader or a partnership or an LLP, actually the cash basis becomes the default basis for calculating your income tax on your trading income going forward. Gone full circle, years ago, the revenue got rid of this, and certain sectors, barristers in particular, has a transitional regime because they were paid so much later, and suddenly their income tax was brought forward. We're actually going back to the position where sole traders and members of an LLP can be taxed on a cash basis. So if your customers typically pay you long after you invoice, that's actually going to enable you to put tax back into a later year due to the cash basis. However, that tax deferral might be helpful, but there is a question of, does it actually give you the full picture of the cash basis if you're running a larger business? If you're ignoring all of your debtors, ignoring all of your creditors, certain sectors, I can see that really being unhelpful from a management accounting perspective. The smallest businesses, yes, that's what they've done it for. But for larger businesses, it might actually be that are operating as partnerships. You may well want to stay on the current accruals basis, because that means you get a full picture of the business and how it's doing. There's a stamp duty relief currently known as multiple dwellings relief. We see it come up from time to time. Someone's bought a house and they've had various letters through from claims agents because there's something that might be a granny annex in the garden, might be an additional dwelling. There's been a lot of claims for reduced stamp duty land tax bills in those circumstances. The revenue, I think, has got fed up with all of this. There's been some spurious claims, there's been some good claims, and actually they've decided that they've had enough of the spurious claims, they've had enough of going through the tribunals with them, and the relief's actually being abolished from the 1st of June 2024. So what that means, if you are in the process of buying or looking at buying somewhere that's got buying more than one property, residential property at once, or something that might have an annex that could operate as a separate property within the grounds, you want to push that through before the relief ends at the end of May. And then another one that was slipped in there is from April 2026, benefits in kind. So company cars, private medical insurance, overdrawn loan accounts, etc. They're going to make putting the tax on those through payroll compulsory. I can see how that's going to work in larger organisations where people know what the benefits are. I think they're going to have to think a bit around how it works for smaller organisations where often we as accountants don't know until later. Maybe we need to be asking all clients if they're taking on private medical, for example, to let us know that sooner.
Bloody hell, that's outrageous. Thank you.
Sorry,
Cheers. Cheers.
Sorry, someone in the background there. I think there'll be a bit more that we need to know on that, but just to let you know, that's coming in from April 2026 as far as the government are concerned. It'll be a change to how payrolls and benefits are treated. And then that brings us to the end of today's webinar. Open it up to questions again shortly, but before I do so, I hand back over to Andy to sort of field any questions to me. The next webinar is back to our usual Thursday slot on the 18th of April at 9:30 a.m. and it will be on commercial funding for business.
Magic. Thanks a lot, Chris. Very informative. A lot of information there, I think. Obviously, a pre-election budget, so we can't. I've got no crystal ball to see into the future, but there's certainly a lot to take in there. I think what I took away a bit from that was there seems to be a lot of stuff relating to estates and things like that. So it's very much looking at strategies, strategic planning on how you're looking at assets, your furnished holiday lets, things like that. Obviously at Harts we've got teams that can help you discuss all those sort of aspects and all that sort of planning. So as ever, please do get in contact with specific questions and specific scenarios. But does anybody from the floor have any questions at the moment they'd like to ask? Please do unmute yourself and shout out. Well, often when we get a hint of silence, so I fully appreciate
I'm not sure
it.
if people can people unmute themselves. I don't know.
Should be able to. There's obviously in the chat bar as well. No, okay. If you do have burning questions, obviously, please do get in contact with us. We're just at the end of a telephone. The frustration we have as accountants sometimes is picking up situations after the event when quite often, you know, we are very keen on clients getting in contact early, speaking to us before making some decisions, because there's usually, as Chris could verify, plenty of different options. Different ways of doing things, different ways of looking at things. So we're always better getting involved at the start rather than when you come across a problem. We can avoid those problems with just a bit of good old-fashioned planning. So please do get in contact.
And actually, if you get in touch with us beforehand, we can ask you the question of what do you want the answer to be? And then it's a question of can we get to that answer rather than you've already done something and we're left picking up the pieces.
Brilliant. Okay, so as Chris highlighted there, next webinar is back to the Thursday slot, 18th of April, commercial funding, which is obviously quite important at the moment. And as ever, if you're watching on YouTube, hope you've enjoyed that as well. And as ever, we keep repeating it, get in contact with any specific questions. Thank you ever so much for joining us today. Thank you for taking your time out to come along to this webinar, and we certainly look forward to joining us at future events. Take care.
Thank you very much.